Hello and welcome. You are listening to the Investor Lab. My name is Goose, and today joining me on the show is Charlie Vella from Vella Media, my good friend from the Property and Business series. You would know him from all of our previous episodes. He's a much-loved guest of the show and friend of the Investor Lab. Now, what we're talking about today was really awesome. We spoke about basically how business owners can replace their own incomes and how to build a real estate property portfolio as a real estate business. Okay, so what we specifically spoke about today was creating a real estate company, how to think about that, how to think about structuring, how to think about profit distributions, how to really change the game in the way that you're approaching your real estate journey in a way that is going to give you more profits, more opportunity, more scope to grow, all by changing the way you can think about this and turning this from essentially a hobby business or a solopreneur type exercise into being a real estate business. And if you can change the way that you think about this, you're going to become a real estate entrepreneur in and of your own right, and you will be able to create a truly scalable property portfolio and achieve what you want out of life so much faster than you would ever imagined. We want to challenge you to think a little bit differently and to challenge the advice that you've been getting, because a lot of the advice out there is based around people who don't have the same goals as you, don't have the same dreams as you, and don't understand property in the way that you do because you're a listener of this show. So without any further ado, let's get stuck right into it. If you've enjoyed this episode, make sure you share it with other people. Let us know that you like it. And of course, make sure you subscribe and do all of the good stuff. But let me stop talking. Let's get right into it. I look forward to seeing you on the inside. Hey guys, welcome back to the Investor Lab. Joining me today is my good friend Charlie. Charlie, how are you?
It's a pleasure to be here. I'm really excited today, Goose. Really. And do you want to know why? I'll tell you why.
Yeah, I'd love to know. Yeah, go on. Tell us why.
I've got an offer in on a property, which of course you know, but I must admit, you wake up with a little glisten in your step, right? It's like there's rose-colored glasses on throughout life at the moment. The excitement. It's Christmas Day as an adult.
Yeah. And it's a screamer too. You guys have been on a bit of a tear lately and really been accumulating some really cool assets, which has been really fun. So I'm excited for you.
Yeah, me too. I think we should do a whole episode. I can't wait until we hit a little milestone. There's a milestone I'm very specifically after. When we hit that, I'd love to do an episode and we'll go through the whole journey.
I've actually been waiting for that too, because normally there's a bit of a bookend. Normally there's like, oh, hey, we've just done this bit of a journey and here's something that we can talk about. But you guys are just, it's ongoing. And it's, so yeah, once we get to the end, we'll go back and take a little look at it. But it's really exciting at the moment. Just a little side note, our process as a business and what we do is continuously being refined and dialed. And I feel like I always feel like we're constantly dialing a little bit closer to an even sweeter sweet spot. So we're really getting down to the nuts of it. Yeah, we're finding some really pretty outrageous opportunities at the moment. Not just obviously the stuff that you know about, but broadly speaking, there's some pretty wild stuff out there. And it's very interesting and it's all because we've been able to enter into markets at the right time. Yeah, I'm super excited with not only your stuff, but how our business is going, but also the results that clients are getting broadly. It's a really exciting time for property. It's a really exciting time for us as a business as well. So,
hugely so. Very excited by that. But today we're talking about something that's been a really big challenge for me in the last month. I've had to learn a lot about this quickly. Yep. I think in the last month, you've also had to dive into this because I'm going through it, which is understanding this whole notion of structures, trusts, where to put properties in what way, where they fit, what they should look at, and then what are the benefits and consequences that come with that stuff. So I thought it'd be really good to go through this. And I wanted to start this episode off with a quote that I love because I think it becomes imperative when you get to this point. Once you've gone past maybe getting your first couple of properties, I think the big breakthrough I've had in recent times is what got you to here won't get you to there.
Yeah. I always say what gets you out of Egypt won't get you to the promised land.
Absolutely. And that's where the premise of this comes down. So let's lay it down. I think in every property person's journey, they're going to get to a point where they probably buy maybe one or two properties in their first home. I know you've covered this in other episodes. And then they get to this stage where different things start to become important. And I'll mention a few. One is that, different structures for asset protection, different structures for potentially borrowing gains, and then different structures for tax effectiveness, and then different structures for legacy, like passing things down.
Yeah.
But this is one of those things where it's just discussed terribly. So I wanted to start this off with the idea of going, well, how do you, now that you've gotten to here and with all the experience you've accumulated and all the different people you've worked with, how do you even begin to broach this topic? Because I feel like it was running into a wall at warp speed.
Okay, so we need to kind of like cook this down a little bit, right? So what we're really talking about is we're talking about portfolio structuring, right? Specifically trusts, company structures, things like that. But this is super relevant, not just to, like every investor, but also to business owners, because there's a really interesting interrelationship that isn't being talked about at all between business and real estate business, right? So the way that I've been shifting this narrative to help people to think about this a little differently, because people have heard trust, and there's some organizations out there that'll say, get a trust for every property. Oh, it's all about asset protection. You might get sued and all this kind of stuff, which just kind of never really sat well with me. I was like, well, I mean, come on. I mean, how many times do you hear about that kind of stuff happening? Not very often, right? So I never really kind of floated with that. And then you've kind of got these other ambiguous ideas around trust, and no one really kind of nuts down why you would do it, where does it fit, and how to think about it. Now, there's a couple of big reasons for that. Now, the prevailing knowledge, and also this is a knowledge that I have held, or the belief that I have held for a fair while, is that you kind of don't need to worry about trusts for the first probably 3 or 4 properties. After that, you might need to think about it. Now, my understanding, and I guess the advice that I had around that was because, it probably just isn't worth it. Like the costs and stuff, it's probably just kind of not worth it. It's probably just a hassle you don't need to have. But I've realized that all of that's actually kind of like not exactly 100% true. So it's not just about the costs. Yes, when you're setting up trust, there are costs associated with setting it up, operating it, and there are some other costs we can talk about in a moment, land taxes and things like that. But here is the fundamental reason that I think that there is so much poor advice around trusts. It's because Australia, by and large, including all of the professionals and advisors and all of this kind of stuff, don't understand, A, you can get cash flow positive properties, and B, that you can, that your desire is actually to achieve a greater level of freedom, choice, and abundance. What I mean by that is a lot of the advice around trust is centered around negatively geared properties. And that advice is so contrarian or so contrary to the things that we want to try to achieve, right? So if the advice is, look, maybe don't get trust straight away, it's probably because they're thinking, well, you can't, if you take losses in your trust, you're not going to be able to, offset the negative gearing against your income, and therefore it's probably not worth it. But what if your trusts make money? What if it's profitable? And how does that then change the dynamic nature of these kind of structures? Am I making sense from my waffling?
Well, there's always an ambiguous way you go around to talking things that I quite enjoy, Goose. We always get there in such an awesome way, always so well expressed. But at the same time, I think you're on point. I think so few Australians are trying to get up to this stuff, trying to go this way, that the advice structure and what is commonly taught as normal is non-existent. Yeah.
Yeah, totally. And it's really fascinating. So how to think about it now, and I guess how my thinking has changed, and we'll kind of need to talk in and around this topic a fair bit to kind of pick it all apart, because there's so many facets and so many sides that we need to look at it, right? So the simple format and the easiest way to think about it that I am now encouraging people to think about it is, you're not building a real estate portfolio, you're creating a real estate business, right? Now, if you're creating a real estate business, or if you're creating any type of business, what do you need to do? You need to create a business entity and a business structure. You may set up a unit trust for a business. Done that in the past. You may set up a discretionary trust. You may set up a company proprietary. There's all kinds of different stuff you need to think about. But essentially, you're going to create an operating entity that is not going to be you as an individual. Now, if you're thinking about building your real estate business as opposed to, I'm an individual and I'm going to go buy a couple of houses, they're two wildly different things. When you start
break it down, this is the hobbyist business that goes and does, the Sunday market once a week, versus someone trying to build a substantial sized business. That's the distinction. Yeah, exactly.
It's the different. Yeah, exactly. It's the difference between being a sole trader or having a hobby business or something like that, and then creating actually a real company. That's the difference. So that's what we're talking about. Now, any real business is going to want to A, operate profitably, and B, have good structures around the distribution of those profits and the management of that money, good optics, all of that kind of stuff. So the way that I'm encouraging people to think about it now is, okay, how are we going to structure this business in a way that is going to give you the greatest continuity and stop you, hitting roadblocks in the future? So just in the same way that if you set your business up incorrectly, it can cause you some major issues in the future, which I have had that experience because I went to, years ago, I started a business and got very bad advice on the structuring of that business. And it wasn't set up correctly. And as a result, about 7 years later, we found ourselves with a huge amount of exposed liabilities, like significant issues that we have had a very hard time unpacking, all because we didn't set it up properly in the first place. So now the way to think about it is like, okay, if I'm going to go and create this business, what is that business going to look like in the future? Just like any other business, right?
How common is that story though? Like I know people this has happened to. It's like they get to retirement age, they've had a business their whole life, but they never got advice. And then now when they sell the business, they're taxed at 55% instead of 30% on a massive sale. Yeah. And like what a difference that makes at the end game.
Well, totally. It's like there's the tax liabilities on capital gains. There's tax liabilities in terms of, ATO liabilities, all kinds of different stuff and ways that you can be overexposed and lack protection if you don't set your business up in the right way. Now, I'm always really careful when we talk about asset protection because I think for a lot of people out there, it's a bit scaremongery.
Definitely. That is you absolutely hit the experience I have had in the recent weeks talking to advisors of it's an insurance salesman. They're selling you absolute insurance quality things here. Yeah,
totally. And it's this idea that, you better make sure that you've got all your structures set up or someone might come and get you, and I don't prescribe to that. That's not how I live my life, etc. But you do need to have some degree of caution, right? So where is the balance, I think for business owners particularly, it's a good idea to isolate your businesses from each other. So, for example, Charlie, you run a media company. It's a good idea for your property portfolio and your media company to not be exposed to the risks of each other. It's a good idea, right? So, asset protection in that sense. Great. Let's silo our asset types. But you don't need to then you wouldn't then create a separate business entity. Well, maybe you do, I don't know. But I'm assuming you don't create a separate business entity for every single podcast you produce to isolate every one of those from being a potential risk to the bigger business.
Yes, they have shell companies. There's something about the Cayman Islands, double Irish.
Yeah, totally. And so this whole idea around, you've got to have a trust for every asset is just madness in my mind. Now, the way I like to think about this from an asset protection perspective is like by like, right? To a certain degree. So if you have a buy and hold strategy, and you're buying assets that you're going to hold for the long term, and they're going to create a portfolio mix within a trust or company structure, then you can hold all of those assets together as long as the risk profile of the assets is relatively similar or is offset by the risk profile of the other assets in the portfolio. And I'll come back to that because that's an interesting idea around how to offset risks using different types of properties. So I'll come back to that. But if, for example, you've got a buy and hold strategy where you're buying some residential properties and stuff like that, and you're putting all of those in a trust versus, hey, I want to go and do a development, which would intrinsically be a higher risk, more moving parts. Potentially you're going to take on some JV partners, different funding strategies, all of this other kind of stuff. It would make sense for you to isolate that as a different business, just in the same way that I have a real estate business. If I decided that I wanted to go and start a landscaping company or a heavy equipment hire company, I would create a different business. I wouldn't just have Dash Dot excavator rentals as part of the same company. I would create that as a separate entity because it's a different type of operating structure. Does that kind of make sense?
Yeah, I love the way we're thinking about this from intention, right? I wish this is how I was thinking about it about a month ago, because this was quite a confusing idea. Is like, if my intention long term is to create a business, right? Not just buy one property to hold forever, and that's my strategy. It's not a hobby. I'm going after this in a big way. It's like one structure per business. If I have a business, that's one structure, the media company in my example, Dash Dot for you. Then if I'm buy and holding, well, that's a type of business. That's my buy and hold business. And then if I'm developing, well, then that's a development business. So that would be three things. They differ by what the organization does or the entity does, how you want to view it. Yeah. So I think that's a very interesting way to do it, and definitely more of the approach I'm taking with my own stuff as well.
Yeah, totally. I definitely want to talk about how businesses can distribute profits into from one business into another, because I think that's a really interesting conversation. I think you will have really good insight into that as well, as opposed to paying out to PAYG. But one thing I want to touch on though is within that buy and hold strategy, because it's very easy to overcomplicate. When do you define a different business from one business from another? Is it okay? I'm going to have one real estate business for commercial, and I'm going to have one for residential properties under $400,000, and I'm going to have one for unit blocks and apartments, or like where do you how do you differentiate that, and when do you start to segment and niche down those businesses? The most interesting thing about creating trust structures, and I kind of covered this. There's an awesome episode that just came out recently with Stephen McClatchy, talking about the kind of funding strategies around this kind of stuff. The most interesting thing about creating a real estate business is, firstly, you want it to be profitable. You want it to produce more income than users, because like any business, you want it to be making money, right?
I just have to pause here, right? It's only in Silicon Valley and property that people think, well, losing money in this is a great idea.
I know, it's wild, isn't it? Right? It's just completely bonkers, right? So you want your business, your real estate business, to create profit. You want it to be profitable. You want it.
Mind blown, Goose. Yeah. Mind blown.
I know, right? Yes, you want the equity to increase. A lot of people make this mistake when they think that there's only cash flow and growth. And I don't just mean in real estate. I mean in business too. Like a lot of people think that, well, I can have a growth business, which means that I must be lose money and just take on millions and millions and millions of investment to be able to fund it. But it's a growth business, and growth businesses don't make profit, versus I have a cash flow business, which essentially doesn't generate any equity and has no intrinsic asset value. It's the same thinking that goes into real estate, where it's like, well, I guess if I want to get growth, I got to have 1% yield. And if I want cash flow, I'll go buy in some tiny little country town. This thinking doesn't make sense. You can have both, right? And so the way to think about that, in the same way as, we're a service business, which but by and large would be seen as a more of a cash flow business than an equity business, as opposed to a SaaS. But we're building equity in our business, right? Same thing goes within your real estate company. You want to be building both cash flow and equity. You want the asset to grow in value, but it needs to be able to wash its own face, self-service its own needs, and all of that kind of stuff. So then the emphasis really, really, really does become about cash flow. Now, not at the expense of growth, but you really need to make sure you have cash flow. The reason being is you're going to have higher operating expenses. You're going to have things like, trust accounting. You're going to have things like land tax implications, et cetera, in the future. Now, the cool thing...
Pause right there, just to give some context around this. In my research, trust creation is what I found in Australia between $2,000 and $5,000, depending on the complexity. And then maintenance of a trust is between $1,000 and $2,000. So just to set some context for people, I know that's going to be a question they have of like, well, what comes up with a trust from there? So that's general premises of extra costs in doing this per trust.
Yeah, totally. And the other, so that's a good point to lay out. So if you're creating a trust per property, and so you're going to be looking at, a couple of $1,000s of operating expenses a year additionally, if your property is only producing $2,000 of net cash flow and it's costing $2,000 just to have it in a trust, then you're basically at a neutral cash flow position, which, you could argue probably doesn't necessarily make as much sense as you might want it to make, right? It's not a bad thing, better than losing money, but it's not ideal. Now, if, for example, though, you had one trust and 10 properties in it, and each of those properties was producing $2,000 of net cash flow, and it cost you $2,000 of operating expenses to operate the trust, then you're going to have $18,000 of profit. Simple way of thinking about it. Now, there are some considerations with trusts, land tax and stuff like that. There's probably a whole... We could go down that rabbit hole in a long way. But just the thing to think about is that there are going to be some costs of doing business depending on how many assets you have in which states and what's the mix of those assets and the values and all of this kind of stuff. So there's other things to think about. The point, though, is that in order for none of those costs to matter, you just need to make more profit. It's that simple. So, for example, if your real estate portfolio is generating $100,000 of net profit, net cash flow every year, and your operating expenses of that property, or let's say gross profit each year, and your operating expenses of that portfolio are let's just say $2,000 in trust accounting and $10,000 in land tax, and that's going to be $12,000 of operating expenses, then your net profit is going to be $88,000. Okay. That's the way to be thinking about it rather than, oh my God, there's a few more expenses. Oh my God. Oh my God. We actually just need to shift our thinking about going, okay, well, how do we increase our net margins? How do we increase our profitability?
See, I will ask you this question. I've thought about this a lot in the last week. Do you think that the real estate industry has an obsession with keeping costs low because there is such low cash flow within the portfolios?
Yes.
I love how quickly you responded to that.
Yeah. No, it's madness, right? Because like
it's like avoiding land tax over getting a good asset. It's like if this is a great asset, even if you have to pay some land tax, it is probably unlikely the greater move long term or even in the short term. But it's like, whoa, land tax. Whoa,
yeah,
whoa.
It's like the classic thinking paradigm. Like, hey, is $1 million debt expensive or not? Well, it depends. If that $1 million debt is making $1 million profit on top, then hey, give me $1 million debt versus $1 million debt where I'm not making any income. Oh my God, hang me. You know, like it. And this is the way to think about it. So then once we start to shift our paradigm to like, oh, hang on a second. Okay, so the key is I just actually need to have a more profitable property portfolio. So I just need to increase my net margins. Is that what you're saying? Yes, it's exactly what I'm freaking saying, right? Because if you can increase your net margins, all of the hurdles that everybody else faces in their property portfolio, they start to disappear. They start to just completely disappear. Like if, for example, you had a business which was making tons of profit, and then all of a sudden the government put in a new levy and said, hey, that business is now going to cost an extra $10,000 to run, and all of the other businesses that were in that space couldn't afford the additional $10,000 and they all collapsed, but you were making $100,000 of profit and you could just climb over the hurdle and keep going, then you're going to be able to mop up all the success. So you start to expand your potential massively when you shift from how do I minimize expenses and shift that towards how do I maximize profit. Okay. And then that starts to change the game around portfolio mix, asset types, net return ratios, return on capital percentages. All of these kind of things start to really transform the way that you think about how to structure an effective portfolio for maximum success and maximum continuity. It's pretty easy. The reason most people get stuck is because they don't create enough profitability in their portfolio. That's super simple, right? The reason that people reach their serviceability caps is because they don't create enough profitability in their portfolio. The reason people never achieve, what they want to achieve in property, the reason they get stuck, the reason that they don't get past 5 properties or 2 properties or anything like that is because they don't have enough profitability in their portfolio. So if you expand on that idea, and because some people might be going, oh, well, what's profitable? Is it $10,000 a year? Maybe. Sure. But if you expanded on that idea and said, well, I've got $1 million of equity in my real estate portfolio, but it's producing, let's just say $500,000 of net cash flow. Well, what's that then going to do? What does that entity look like? So if you had a business separately, just forget about it being real estate. If you had a business that was producing $500,000 of net profit and had equity on the balance sheet of $1 million, do you think that you would be able to use that asset, that business, to go and borrow money, to go and buy more assets, maybe buy another office, things like that? Yeah, of course you would, because standalone, that business is going to be a profitable, valuable entity. So the more you can think about how do I create a profitable and successful real estate business, the further you're going to be able to go.
I will say, I think a lot of the advice to go deeper than this is like, one, there is clearly an obsession with keeping costs low because yields are weak or their profitability of their business is weak, which is just along the lines of, okay, don't hire anyone. Let's make sure we use all the cheapest tools possible in my business to make sure that we get far and keep profit high, which I just think is a bad attitude in general.
Yeah.
But then second to that is that when you talk to these advisors or anyone else, most of them are only operating from the paradigm, well, person might get to 3. 3 properties is maybe their ambition or goal. So a lot of this stuff just doesn't become relevant in that conversation. So they become conditioned to think this is the way. They really do. It's not structured around people who want to go, let's say 5 plus properties or a bigger substantial way. And I love the entity thinking. And it's like, if you are approaching your portfolio from like, how do I make this a profitable business? The thinking swaps completely. The ideas swap completely.
Yeah, it massively shifts. And it also changes the way you can think about the types of properties in a portfolio mix. So
let's go there. I think this is an interesting conversation. I think let's say that you're someone who's going to get sweet. I'm going to get a trust set up. I'm going to start building my property business.
Yep.
Sorry. And I'm going to start putting this together. How does asset mix? Do I just go, all right, all my growth assets are going in one trust, or my cash flow in another, developments over here? How do you mix it up?
Well, let's just be clear. So let's actually take a little step back and let's think about a couple of things. So firstly, if you've got a discretionary trust, you can distribute profits, or you can distribute dividends and stuff between different entities. Right? That's the benefit of having a discretionary trust.
Let's just articulate that, because I had to learn this one. If you and me had a discretionary trust, we can discretion where the profits go. So we can say, sweet, 100% to Goose this time, 100% to Charlie next time, or 50-50 each, or 70-30. We discretionally can move that at our whim.
Yeah, which is awesome, right? And that allows you to control the flow and direction of your profits in a way that is going to be most advantageous to you at any given point in time. Yeah. Pretty simple.
And then as comparison, just for the people at home, a unit trust is defined. So if we say, Goose, it's 50-50, right? You cannot change that. That's the units of the trust set up. So you own 50 units, I own 50 units.
Exactly. So if we had a business together and we made $100,000 profit and it's set up as a unit trust, and I owned half the units and you had owned half the units, and we made $100,000 profit, I'd get 50 grand, you'd get 50 grand. If we had a business that made $100,000 in profit, and we decided that we were going to focus on building your property portfolio one year and mine the next, then you might take 75% of the profits that year, and I might take 25% just going on a holiday or something like that.
Can we just use an example of where this is relevant? Let's pretend, right, we have a discretionary trust and I sold my media company. All right, I've got a big year of like income coming in and capital gains to deal with. It might be a really good option not to take from my discretionary trust at this time, because there's so much income coming from another area that it might be beneficial for things to go a different way. Now, of course, speak to your tax advisor, but there are circumstances where you would want to change where money goes in your life or who it goes to.
100%. A really classic example is for business owners who actually have a business, right? Rather than you paying yourself more money. Let's say I'm a business owner, which I am, and I want to grow a property portfolio, which I do. There's a couple of different ways to think about it. Do I need to increase my salary in order so that I can have more personal money to go and build a property portfolio? Does that mean I need to increase my wages and pay more super and pay more marginal income tax rate? Is that the way to think about it? Well, maybe you could do that if you need to increase your personal serviceability. It's one way of thinking about it. Should I pay myself a dividend so that I don't have to pay superannuation, but that will increase my my income and therefore affect my marginal tax rate as well? Slightly better. What about if I had enough income and my income was satisfactory to support my lifestyle and my borrowing capacity? But what about if my business could pay a profit percentage to my real estate business and pay company tax rates as opposed to personal income marginal tax rates? Would that be a more efficient way to think about distributing profits?
If you're a business owner and that doesn't make sense to you, you need a better accountant.
Yep. It's pretty wild if you can think about it like that. And here's the thing, even if you're not currently a business owner, if you can start thinking about things like this, you're going to find ways to be able to make this work for you. This isn't some secret cabal only for people who have started a business and all this kind of stuff. This is all about mindset. You need to be able to retrain the way that you're thinking about the flow of your revenue in your personal life and in the business of you, in order to make this work in a more meaningful way, right? There's some interesting stuff there. So if your business can then pay a percentage of the profits straight to your real estate company, you can then start to divest funds from one entity into another entity. There's one thing to think about. Now that you've got money flowing into your real estate business, which would theoretically be set up as a discretionary trust so that you can control the outflow or the profitability distribution of profits from that trust in a way that is meaningful to you and your family or other beneficiaries of that trust, then the way to think about it is, okay, well, how do I need to think about portfolio mix in terms of types of assets? Now, there are a couple of ways you can think about it. You could have...
I just had to laugh. We started this idea 5 minutes ago, went a completely different way, and have found our way back to portfolio mix. So you get on these episodes, spot on.
Totally. I knew I was going to get there, right? So there's a couple of ways you could think about this. Now, maybe there's no perfect way. So let's talk about a couple of ways. You could have one trust, which is like the Goose McGrath cash flow property trust. And it's all about cash flow. It's just only cash flow properties. And then you could have separately, you could have the Goose McGrath growth trust, and you could have properties which are only about growth. Now, where you're going to find it a little bit tricky is how do you fund those different, how do you fund those companies? You know, if one is producing more profit than the other, but you could, at your discretion, distribute cash flow profits from the cash flow trust to the growth trust that could interlink those two trusts and therefore create funding potential. It's one way I figured about it. Does that kind of make sense? Or is that too ambiguous?
I think that what you mentioned is certainly an idea, but it's definitely an advanced strategy. I think your accountant and advisors would want to be absolutely on point in how to do that, because there are some complexities to what you just described.
Totally. And I don't actually think it's the best way of doing it. Like, you could do it that way, theoretically. A way better way to do it, though, would be to go, okay, how do I maximize growth and cash flow within one company? How do I create one really high performance company? So the way to think about that, and particularly within the context of increasing profitability, is you do need to have growth assets in there. Now, typically, well purchased, well placed residential real estate assets are going to grow much faster than, say, commercial. But here's a little thing: you could theoretically stick a commercial property purely for the function of cash flow into your real estate business, for the function of liquidating the capital within that entity. So let's say you go and buy 3 or 4 or 5 residential real estate assets, which are all cash flow positive and self-supporting and all of that kind of stuff, and it's all good, and you're creating some profit there. You could actually supercharge that by whacking in something that is singularly there for a cash flow function. Now, the thing with commercial real estate is that it is inherently riskier, because what you're essentially betting on is industry stability. And all you need to do is look at things like the retail sector and everything recently to understand that whole industries can be disrupted pretty quickly. And there's an inherent risk when what you're hedging against is industry stability, etc. But if you're a business owner, there's no reason that you couldn't buy your own commercial space, office, or whatever the case may be, in your own trust, and then use that to fund the rest of your real estate portfolio and get the business to rent it back off your trust to create that stability of income in there. And then you can increase the cash flow within your portfolio, and you are in control then. So, for example,
I love this one. I love this one, because this is the hidden advantage that business owners have they may not be aware of.
It's wild, right? So let's just say, for example, I've got a business and I want to go and rent an office space for my team. And let's just say that rent is $100,000 a year, which wouldn't be wild, right? So I could go rent an office space for $100,000 a year, and I could pay somebody else rent. All right, cool. I could do that. Or if I had built enough assets up in my real estate business and I had enough equity available, I could go and use the equity within my real estate business to go and fund the deposit for buying an office, right? Now, I could then, my business could still pay my personal business, my services company could still rent that office space, but rather than renting it to some other landlord, I could rent it off my real estate business. And that $100,000 of revenue, rather than disappearing off into the ether, is still a real cost to my services business, but is getting paid to my real estate business. And then all of a sudden I have $100,000 more revenue getting pumped into my real estate business, which is then going to supercharge the ability for that entity to be able to leverage its own equity, buy more properties, and really start to accelerate. It creates a crazy flywheel effect. Now, where I was thinking about portfolio mix, though, is you want to be able to manage that risk. So if you're a business owner, maybe you do have the ability to go and buy your own office space and do that kind of really cool hidden advantage. If you're not a business owner and you don't have that opportunity, you might think about, okay, should I buy a small commercial asset, and how would I manage that risk? So you want to be able to offset that risk with the other assets in your portfolio. One commercial property by itself, let's just say that's got a risk factor of 10. One commercial property in a portfolio that has 5 other residential really stable assets, that portfolio or that real estate business might have an adjusted risk factor of 5. You know what I mean? So you can kind of manage risk by having more stable assets surrounding it.
It's such an interesting idea. This has probably been the most shaping discussions I've had in the last few weeks is about these trust structures. One of the conversations I had, and I want to add into this, is the whole idea is that you're basically talking about, as an example here, you might put one cash flow, one growth, one commercial asset in a trust. You might put three, and then the risk each of them inherently has is mitigated by the benefit of the other. So your cash flow asset might have no growth, but you've got a growth asset in there to provide the growth.
Yes.
And then you've also got a commercial asset for some reason that doesn't fit into that mix of those two in this example. But it's balancing it out. You might have higher cash flow, but it's a riskier cash flow in that commercial asset. So again, you're balancing it out in these other areas to create a safer asset or a location diverse asset. So the trust becomes a much more mixed thing, which I think is so interesting in there. So interesting. And especially when you think you could tenant your own commercial asset, it throws the mix into such a different view. And this is why this is so warping, right? How different is this conversation we're having now and the way we're thinking about trust than I know for myself when I started out in property? It's like, this wasn't the thinking at all. This isn't even the stuff I was considering.
Yeah, it's the more that you think about real estate like a business, the more it changes the way that the way that you will approach real estate. So even as we said, the types of assets you're going to select and why you're going to select them, and the diversity of the location. And as you say, within your real estate business, you will want to then, there's so many different ways you can diversify by asset type, diversify by outcome that you're after, whether it be growth or cash flow, multi-occupancy, so you've got better rental stability, all of these kind of things. Location, how are you offsetting costs? You might find that right now, the best properties and the best opportunities are all in Queensland, but then you might go, well, how do we offset the fact that that's now going to create more land tax because we're going to have more assets in one state, for example, whereas some states are going to have land tax from the first property you buy. And then, so you've really got to think about all these kind of things. But again, leaning back to what I said earlier, all of that stops mattering if you create enough profit in your portfolio. Like, none of it actually matters. Oh, okay. So, oh my God, I got a land tax bill of $100,000. Does that even matter if your portfolio is producing $500,000 of profit? Maybe not.
I think you think about it differently if you're in that position. I think if you're on a squeeze and you get a big bill, like if let's pretend you're someone out there and you've got $1,000 in your bank account and you get a bill for $2,000, like, I can see why that would cause duress, stress, make you uncomfortable. If you got $1 million in your bank account, you get $1,000, it's like, oh, no biggie. You roll on.
Okay, yeah, cool. Let's move on. And so the emphasis really needs to be on profitability. And it's fascinating because there are people out there who have, there's one guy in particular that I know of who's got 240 properties. And I was actually on a webinar in a mastermind group talking about, basically how to think about your real estate portfolio as a real estate business. And somebody mentioned this guy has got 240 properties. Now, I happen to know that a lot of those properties are extremely low value assets, which is totally fine. And there's no critique. And hey, look, fair play to him. He's got 240 properties, for crying out loud. That's pretty awesome.
240 properties, even at $100,000, is still very well done.
It's extremely well done, right? So I'm not critiquing his ability to get to that number. That's all good. But the question you've got to ask yourself, though, is it better to have 240 properties, or is it better to have 10 really well thought out or well positioned or highly profitable or really good value and better performing assets? Now, intrinsically, you're going to have lower costs and better, like, you won't have as much diversity, of course. If you could own 1,000 apartments versus only one apartment, for example, you're better off owning 1,000 because you're going to have a better rental stability. But there's an element where you need to think about what that asset, where that asset's going to fit within the total vision of what your real estate business is going to do for you, as opposed to just getting caught up with things like numbers and stuff like that. Because it's very easy to chase, for example, yields. It's very easy to go, all right, I guess if I just need more profit, I just need higher yields. I'm going to just get anything that you just find wherever you can get the highest yields. You might end up buying a studio apartment in Mount Isa, which might have a 17% yield, but I don't know, like what's the rental stability like? What's the how long is that going to be vacant for? And is that really going to be a healthy addition to your portfolio? I heard this really interesting story recently of somebody who bought a bed sit, so basically a studio apartment. In fact, what it was is actually a hotel room that had been strata subdivided from the hotel and was being sold as an individual room. So it was being sold as a bed sit. Purchase price $8,500, rent $250 a week. The guy just bought it. The guy bought it on his credit card. He said, "Yeah, okay." Bought it on his credit card.
That's a great story.
Yeah, it was just, it was awesome. And like, hey, put in that position for $8,500, I might buy that too. But
I might risk that. I think I'm okay with that risk appetite.
I'm okay with that risk appetite as well. And I was like, well, yeah, I'd probably do the same. I'd probably just like pay the $8,500 and get that because that's pretty cool. But the thing is that really the structure on which you want to base your whole portfolio? And it's the same as selling, low price products versus high price services. And you've got to look at what those margins look like over the long term and also what the operating complexity is of your portfolio and how you want to manage that.
Completely agree on that. I want to ask you something different here, still related around this topic, because I've been having many conversations around this recently. At many points in, I'm sure, your life and mine, new information comes to light and we look back and we go, I won't say the F word, but I should.
Yeah.
All right. So, for example, in this context here, someone's listening to this podcast, they've maybe already got a few properties and they're sitting there and go, I have completely ignored trusts and structures. I can see that maybe this is something that I should be paying more attention to and I want to go seek professional advice and look at it. How do you weigh up the ideas of, okay, I've bought a property, it's not in a trust, it's in a personal name, hint, hint, I've done this. And then I look at it and go, how do I evaluate or think about moving assets and the expenses that go with that over the long game? And I'll put some caveats in. For some people, they may not, if you're moving the asset, there are costs that will be triggered, like stamp duty. But is it worth considering it when you look at the long game and thinking bigger for your business in general, your property business here?
It's a good question, and it's not one with an easy answer, right? So if you look at really black and white, most people can't, like the opportunity cost. Let's say you've got 4 properties outside of a trust, and then you go, oh my, and they're all worth $500,000. You've got $2 million worth of property, and you're like, oh my God, now I want to transfer those into a trust. And I'm going to trigger stamp duty and potentially capital gains and all this other kind of stuff. It's a lot of money to consider.
About 20 to 25 a pop.
Yeah, totally. So then the question is, could you put that money to better use in continuing to build your property portfolio?
Potentially, that's another deposit. If you were going to do all 4, that's $100,000 there. It's potentially your next purchase.
Yeah, exactly. And then that next purchase, you could purchase it in the trust, and you could make sure that it's a really highly profitable purchase and all of that kind of stuff. And you can kind of just draw a line in the sand and move forward. Now, what I'm about to say is, I'm not saying this with enough authority that I'm like, hey, you can definitely do this. But
just as a caveat, if anyone's taking this podcast as financial advice, you've got bigger problems in life.
So there's an argument to be had, and I don't know the legal complexities and ramifications of this. But capital gains is triggered based on the profitability of your purchase versus your sell price. So, for example, if you bought a property for $200,000 and then it was now worth $500,000, then you would have a $300,000 capital gain, and that's what you would be taxed on. However, and also stamp duty is based on the purchase price. So theoretically, if you were to sell those assets at a loss, you would not pay any capital gains tax. And also, based on the purchase price, you would not pay the same stamp duty as you would if you were selling a property for, say, $500,000. So theoretically, you may be able to sell the assets from yourself to a business, i.e. a real estate business, at a loss and manage some of those costs. Now, obviously, that's pretty grey, but that's a way to
very grey. I'm sitting here and my there's definitely things and hurdles, and I would say without doubt the government has put things in place to stop people doing this.
Totally, but there's degrees to which you can manage that. So I'm not saying, hey, go and sell a property for $1 into your trust and bazinga, you're off. you wouldn't be able to do that. I would say that would be, be a bridge too far. But there's got to be some ways to manage that. There's got to be ways to be able to manage that and potentially mitigate some of the costs. And that's something you'd obviously need to get independent advice on. But that's one way to think about it, More specifically, though, I would suggest just drawing a line in the sand and moving on. As long as you can continue to support that as a strategy.
Yeah, it's an interesting idea. Certainly one worth speaking to your advisors about, and accountants and tax lawyers and all the rest. One more thing I just want to broach quickly before we round this one up is land tax.
Yeah.
I think land tax is a bit of a taboo topic in real estate. It's like this secret. I mean, I'm scared of it. I didn't really look into it till this week. I'm like, I got to avoid land tax. And I'm like, well, how much is land tax?
Yeah.
So what I wanted to do is just broach the idea of how land tax works, and then some of the differences just quickly here. And we'll use the one I'm mostly interested in right now or thinking about is that the way land tax works is that it only gets triggered once you cross the threshold, and you only pay the land tax on the amount above the threshold. It doesn't trigger on the whole amount. So for example, I'll use Queensland because I know this one. If you have a property and the land is worth $600,000 or less, no land tax in your personal name. If it's in a trust, it's $350,000, anything above that. For land value, that is not building value, that is land value. It's land tax. Once you cross over that, if you're over that by $10, you would pay 1 cent per dollar you're over.
Yeah.
Like, it's not a huge amount.
No.
If you're only a little bit over in certain ways, right? It's not necessarily something to hit the panic button about, yet we treat it that way.
Totally. And I think that this is again the scare tactics, right? So no one wants more expenses than they need, right? So it's, as ever, like with any tax or with any expense, it is important to be efficient, and it's important to approach it intelligently. So, for example, you don't want to go and pay more personal tax than you need to, but at the same time, you shouldn't go and incur additional expenses purely for the goal of reducing your tax or reducing your income, right? That would just be madness, right? So that's good. The broken way of thinking about it. So in the same sense, yeah, you want to be land tax efficient, okay? You want to be mindful that the more assets you accumulate in different locations and based on their different requirements. So for example, in Victoria, it's anything in a trust or a company, it's anything above $25,000 in land value. So basically from $0, basically everything. You want to be mindful of what that's going to mean in terms of additional expenses, but you don't want to let that hold you back, right? So in New South Wales, it's basically from day one, right? So if you've got a trust, you're paying land tax from the first dollar of land value. Does that mean that you should never buy in New South Wales? No, it doesn't. It just means you need to think about what the impact of that is on your portfolio. So, for example, in Queens or in Victoria, for example, above the $25,000 of land value, it's 0.375% of the land value, right? So it's a pretty small amount. So you just need to factor that into the cost. But it is something you need to be smart about. I certainly don't think it's something to be scared of, because what you actually need to consider is this the best place to invest? Now, in the grand scheme of things, all of these expenses should be helping you to achieve a greater wealth goal, not detracting from it. So if it's the difference between you making $1 million or making $0, just go and pay the land tax and deal with the expenses, and this is the kind of way to think about it. The other thing to think about when you've got a trust set up is a lot more stuff becomes a lot more tax deductible as well. So it swings and roundabouts, whereas, for example, something like a buyer's agency service or a strategic advisory and acquisition management service or any of these other kind of things, as an individual, they may be seen as an expense. As a company, they would be as a personal expense. You might not be able to claim as an individual. As a company, that becomes one of your operating expenses. Okay, well, you needed to get some consultants for your company and all of that kind of stuff, and so it changes the game in terms of what you can claim against what. So there's swings and roundabouts. So I don't think it should be something that we should be scared of or shy away from, because it's not huge. We just need to know about it so that we can manage that risk. But again, leaning back to where we said at the start, do we think a lot of the bad advice comes from people who don't understand that you can buy properties that are profitable, that don't understand all this kind of stuff? Yeah, because I mean, if your portfolio is already losing, I don't know, $10,000 a year or $30,000 a year because it's negatively geared, and then on top of that you're adding, I don't know, another $10,000 of land tax in the grand scheme of things. Yeah, that's pretty hairy. But if your portfolio is producing more profit than the tax costs, then
it's less concerning.
Totally, way less concerning.
All right, guys. Well, let's wrap this one up from here. This has been a whole bunch of fun, and of course, I'll finish this one off by saying we are not finance tax professionals. If you are going through this, please make sure to talk to qualified, well-represented people. But I will say this, verify. The ideas we're talking about, they should understand and be able to say, that's complete rubbish, or actually there's some merit to that. So make sure you are getting independent advice. Make sure you're speaking to several people. It's helped myself a lot, and I'm sure Goose. Anything else you want to add in?
No, I think that's awesome. No, I think it's great. I think the more that we can have these kinds of discussions, the better off we'll all be. I think the real estate space is too populated with outdated ideas around all of this kind of stuff. And no one is actually trying to push the envelope and go, well, actually, let's all just think about this a little differently and let's achieve way, way more. And I think if you can start to crack the code of some of these ways of thinking differently, you're going to be able to accelerate much further and much faster than the average investor and ultimately achieve what you want in life so much faster. So on that note, if you've enjoyed the episode, make sure you share this with somebody else. Make sure you let us know and give us some feedback. We love the feedback and we look forward to seeing you on the next episode.